REITs, or real estate investment trusts, are one of my favorite investments, especially within my Roth IRA. REITs are a great way to add real estate exposure to your portfolio, and REITs also offer high dividend yields. So whether you are new to REITs or already more familiar with REITs, make sure you stay tuned throughout the entire video, because today we are going to be talking about 10 of the best REITs to own for long-term wealth building. But before you invest in any of these, make sure you perform your own due diligence, as this is not financial advice. With that being said, let's roll the intro. Hey everyone, Mark here, back for another video. And if this is your first time joining us, welcome. On this channel, we talk about building wealth through dividends, including REITs, which is one topic we are going to discuss today. So if that interests you, make sure you subscribe to the channel so you are notified anytime we drop a new video. And I want to send out a huge shout out to The Motley Fool for sponsoring today's video. If you go to fool.com/Mark, you could sign up to get a list of their top 10 stocks to buy now. And with that being said, let's get into today's video of the top 10 REITs to own long term. For each of these REITs, I'm going to give you just a short blurb on what the REIT does and what they focus on. We're going to look at their market performance, their market cap size, their dividend yield, and their payout ratio, along with any dividend growth stats that might come along with those prospective REITs. So let's start with the first REIT, being Realty Income, stock ticker O. Realty Income is the gold standard when it comes to REITs. They are a net lease REIT focusing on the retail sector. Realty Income has a very diversified portfolio of properties. They also focus on high quality tenants, with a majority of their tenants being investment grade. They also have a very strong capital structure. They pay a monthly dividend, and they coin themselves the monthly dividend company. Realty Income has a current market cap of $39.6 billion. Some of their notable top tenants include CVS, 7-Eleven, and Home Depot, just to name a few. On the year, shares of Realty Income are down 11.5%, and currently the company pays a dividend yield of 4.7%. That dividend has a payout ratio of 75%. Again, with REITs, we're going to see higher payout ratios, just due in large that they have to pay out at least 90% of their taxable income in order to qualify as a REIT. Realty Income has now increased their dividend for 25 consecutive years, making them one of the few REITs on that prized dividend aristocrat list. The second REIT we're going to look at is WP Carey, stock ticker WPC. WP Carey is a net lease REIT with a focus on warehouse and industrial, which makes up 51% of their entire portfolio. The company has slowly transitioned away from office-like properties, but they still have some exposure, and they also have exposure to self-storage properties, which is another great sector to be involved with. In fact, U-Haul happens to be their largest tenant. The company currently has a market cap of $16 billion, and on the year, shares of WPC are down 5.1%. The company currently has a dividend yield of 5.4%, and that dividend has a payout ratio of 83%. The company has increased the dividend for 8 consecutive years and counting. The third REIT we're going to look at is Simon Property Group, stock ticker SPG. Simon Property Group is the largest mall landlord here in the US. The company has both indoor and open-air malls and premium outlet centers around the US and internationally. When you think of malls, you think of a dying breed, but Simon Property Group owns the best performing malls in the world, with strong retail sales per square foot, which is why their portfolio is made up of A-rated malls. Many of the malls that have been going out of business or went through that lull of going out of business were C-rated or lower rated malls, meaning the retail sales per square foot from the tenants continue to decrease, and this is exactly how mall portfolios are classified. Simon Property Group currently has a market cap of $43 billion, and on the year, shares have been under pressure as they are down 27.7%. The company has a very juicy dividend yield of 6.2% and a very low payout ratio of only 60%. The dividend was cut by 38% during the global pandemic in 2020, but since then it has grown 38% with 3 consecutive quarters of dividend growth. The fourth REIT we're going to look at today is Vici Properties, stock ticker VICI. Vici Properties is a hospitality and gaming REIT. They own properties such as Caesars Palace, MGM Grand, Luxor, Mirage, The Venetian, New York, and many other along the Las Vegas Strip and throughout the United States. In fact, Vici is the largest landlord on the Las Vegas Strip. Vici currently has a market cap of $31 billion, and on the year shares are positive by 5.5%. The dividend yield currently sits at 4.9%, and the payout ratio at 73%. The dividend has grown at an annual rate of 10% per year each of the past 2 years. The fifth REIT we're going to look at today is Avalon Bay Communities, stock ticker AVB. Avalon Bay is one of the 2 largest apartment REITs here in the US today. The company operates in major markets which include New England, New York, the Pacific Northwest, and California, with growing number of people and higher income levels. They have over 270 plus apartment communities within 12 different states and have high demand with occupancy rates consistently above 95%. The company currently has a market cap of $23 billion, and on the year, shares have been very under pressure as they are down 36%. The dividend yield currently sits at 3.9%, and they have a low payout ratio of 62%. Before we get into the final 5 REITs, let me tell you about a promotion going on over at Webull. If you sign up for a new account at Webull and deposit any amount of money, they will give you up to 12 free stocks valued up to over $30,000 just for signing up and depositing any amount of money. Definitely take advantage of this. Link is down in the description below. Now onto our 6th REIT of the 10 that we're looking at today, and that is Agree Realty, stock ticker ADC. Agree Realty is also a net lease retail focused REIT, built very similar to that of Realty Income. Agree Realty also focuses highly on the quality of their tenants, with 68% of their annual base rent coming from investment grade tenants. Some of these top tenants include the likes of Walmart, Tractor Supply Company, Dollar General, CVS, and Lowe's, just to name a few. The company has a market cap of $6 billion. Year-to-date, shares are down 4.5%. The company has a dividend yield of 4.2% with a payout ratio of 74%. Given the most recent dividend hike that we saw last month, the company has now increased their dividend for 10 consecutive years. The 7th REIT we're going to look at is Iron Mountain, stock ticker IRM. Iron Mountain is more of a storage REIT. That's how they really got their name, but they are transitioning more into a data center REIT. They have really expanded their data center, and that has been a growth driver for the company over the past few years and continues to be a growth driver moving forward. Iron Mountain currently has a market cap of $14 billion. On the year, shares are down slightly by 3.5%. They have a dividend yield of 5% and a payout ratio of 79%. The 8th REIT on our list is American Tower, stock ticker AMT. American Tower is a cell tower REIT. All of the wireless carriers right now are battling it out. Think of Verizon, AT&T, T-Mobile. They're all battling to try and get consumers to use their services. But at what price? This has eaten into margins for those businesses and increased customer acquisition costs. So why not instead own the infrastructure behind those carriers that are necessary for the services to work and will only continue to grow with the rollout of 5G both here in the US and internationally. That is what American Tower does. It builds cell towers and leases them out to carriers. The company is one of the largest REITs in the market today with a market cap of $94 billion. On the year, shares are down over 30%. The company has a dividend yield of 4.9% and a payout ratio of 73%. Over the past 10 years, shareholders of AMT have received a dividend increase each and every year. The 9th REIT on our list is one of my favorites, and that is Prologis, stock ticker PLD. Prologis is a warehouse REIT, and with the growth and the boom we have seen in e-commerce, and let me tell you, this is not something that is slowing down anytime soon, That makes Prologis very intriguing, especially at current prices. Prologis is a global REIT that owns, manages, develops, and acquires high-quality logistics facilities in multiple countries around the world. Their properties are in not only high barrier, but also high growth markets. With an ever-growing demand for that last mile delivery and e-commerce, the logistics business has been growing substantially, and I expect this to continue moving forward. One of the company's largest tenants is Amazon. Prologis has a market cap of $101 billion, again making it one of the largest REITs on the market today. On the year, shares are down 35%. The company has a dividend yield of 2.9% with a very low payout ratio of 60%. The dividend has increased for 8 consecutive years and counting. The 10th REIT on our list of 10 today is STAG Industrial, stock ticker STAG. STAG Industrial is an industrial REIT, as you probably could have guessed, and like Realty Income, they also pay a monthly dividend. The company has properties across the U.S. With over 500 buildings in 40 states, STAG has become wildly diversified across geography, and they also have great lease maturities. STAG has continued to grow its dividend while also lowering its payout ratio, which is something that many can't accomplish. Combining their acquisition strategy as they continue to expand and grow their portfolio, along with the same-store rent growth we have seen, I expect STAG Industrial to continue to expand in the foreseeable future. The company currently has a market cap of $6 billion. On the year, shares are down by 34%. Shares of STAG have a dividend yield of 4.6% with a very low payout ratio of 67%. This monthly dividend has grown for 10 consecutive years and counting. So there's our list of 10 REITs for you to consider for your portfolio. Down in the comments section below, let me know which of these REITs that you already own. Which of them are your favorites? And with that being said, please hit that like button, subscribe to the channel so you're notified anytime we drop a new video. And with that being said, we'll see you next time. Take care.